Are you tired of the same old market updates, same old thing, stats that we don't understand? Well, the truth is that there's a ton of information out there. We are in a not so normal time in real estate. People are talking about high interest rates and low inventory, and what's that all mean? We're going to unpack that next for the August 2023 Denver and the Suburbs Real Estate Market Report. Stay tuned. What's up, guys? Jeremy Kane, eXp Realty and Living in the Denver Suburbs on YouTube. Please like, comment, subscribe. This is something that I'm just trying to take all of the stuff that we've been saying for so long and bring it down into a bite-sized format so that you can understand the opportunities that lie in the market and maybe the non-opportunities that lie in the market as we move forward. So let's start off first. Obviously, a lot of these stats come from market professionals. I'm constantly studying the statistics, and a member of DMAR who puts out a wonderful market trends report. Absolutely check that out. I can even link that below if you're really interested in diving into the spreadsheets and things like that. But as an agent, transactions are down, right? And I've been lucky enough to really deal with the people that have to move and are wanting to move, and the buyers that are trusting me and the knowledge in the market to understand that now is an opportunity, and I've had a really good year. However, I know that's not the case across the board. I know other real estate agents, lenders, the transaction amount is down. We are lucky in Denver as agents and as title, people and lenders to have an escalating price structure. So the total incomes are typically not affected, but there are agents that are just having no deal. So what's that mean, and why is that happening? Well, the biggest thing is, the inventory. And I will tell you, inventory's up 17%. 17% of not a big number. So 4,289 homes were active at the end of July, which, is great sign that it went up a little bit. However, the inventory of 4,289 homes is very small. For average comparison, if we take out the crazy years of the pandemic and those surrounding 2013 to 2019, the average, at the end of July was 6,490 homes on the market. So we're still tragically short of that number, and that's causing, with the influx of more people and more people and more people coming into the market, that's really, a small number, and that's why we're not seeing a buyer's market. So a lot of our numbers are affected, and people are like, okay, we're down, it's down. Homes are still moving, but there's just less homes available. Buyers are being a little more picky. Their buying power is a little bit more, subdued with the higher interest rates, and so that's what's affecting it. A 9.3 drop in pending transactions. So we are putting less homes under contract, from the pending side. So, inventory up, pending transactions down, that's pretty good. Decrease, we're 14% down, and homes sold in July year over year. So just understand that that's, we're shrinking the inventory and the transactions, and so there's less homes being sold. But that doesn't mean that it's becoming a buyer's market that's harder to sell homes. There's just less homes being listed because of, the interest rates, being locked in at below 4 or below 3 in some cases. So to really make a move, it has to be, something that matters. And as we move forward, year over year decline of pending transactions, we're down 10% of pending and down 13.8% of closed. So as you can see the trend, but it's really just because the inventory is so limited. And so that is that, right? And as we move forward, seasonality, we're approaching, 1.7 months of inventory, which is, great news, obviously in the height of the pandemic and things like that. We got down between 10 and 20 days of inventory. It's absolutely crazy that if no homes listed, we'd be out of inventory in 10 to 20 days. For reference, a balanced market is 6 months of inventory, and we're at 1.7. So all of this is just, a normal seasonal trend with limited inventory to start, but multiple offers are becoming less of the norm. And that's why we're really talking about this, because you can talk all day about the cost of money, right? And how much interest rates are, and 7% this and 6% that, and yeah, interest rates are super high compared to what they were, and they doubled over the last 18 months and all of that stuff. But it doesn't really matter what they used to be historically. It matters what they are now, because technically the price of the home mixed with the higher interest rate is what the affordability crisis is kind of coming down to. And so as we move into the cost of money, we talked even on this channel about May 10th being the chosen day where the Fed was going to be, done raising the Fed rate, and that was going to be a great day. Interest rates were going to come down. The market was going to open up. We've talked about this on several occasions, and we know that didn't happen, on May 10th, as we sit here, 2 months, 3 months later, and, we're still, in fact, between May 10th and the end of May, interest rates rose 3/4 of a point. And so that was something that was less unexpected by the economists and things like that, but goes to show you that, we're not there yet. We're not at that tipping point. We talked a lot about this spring and Q3, which we're in now, being kind of the race. Now we're talking, maybe next spring, maybe next summer, once those rates drop down. There's 64% of buyers sitting on the sidelines right now waiting for those interest rates to drop. What those people are not being told by the headlines is that when those interest rates drop, 64% of the pool is coming to the market. They're going to rush to the market because they're going to be sick of renting. They're going to be sick of waiting. They'll be like, oh, here's our opportunity. Interest rates dropped 0.5 point. Interest rates dropped a point, whatever that looks like. And then there's going to be all of this rush to activity. There's no hope for inventory to get caught up by then by any stretch. The builders just can't do it, the labor, whatever that looks like. And so they're going to be hit in the face with, instead of high interest rates, they're going to have to overbid and get in bidding wars, driving the price up, in turn not having the ability to take advantage of refinancing into a lower rate at that point in time, and the gift of the equity that's going to come with that. So those buyers that are waiting on the sidelines, let's talk, because now may be a perfect opportunity, because you can get in, get that interest rate. You can always refinance the rate as long as the house prices doesn't fall off and all of that. You got to make sure your credit's good and take care of some things there. It's not a foregone conclusion that you will absolutely be able to refinance. So make sure you're comfortable with the rate you're at, and don't just do it just because. But think about this. You get into a home, 6 months, the interest rates start to come down. They're dropping enough to make a difference so you can refinance. But those other 64%, or hopefully 60%, because I'm trying to get those 4% off the fence, are going to come to the market. That's going to drive the price up. So you're going to benefit from the equity at that point in time. And so that's what we should really be talking about with these interest rates, because the amount of people that are waiting on the sidelines, because mortgage applications are down 26%, because multiple offer situations are cooling, now may be just the right time to get in, get something that works, quit paying your rent, and take advantage of that. So as we move into, the other stats and what's going on as a result, it'll show you, okay? Average sold price in Denver, $781,509, down just 1.9% from June. Not a major deal when you're talking average price point at $780,000, right? Median price point stable at $650,000. These are big numbers. When we're talking about median and average, obviously the average gets thrown off by outliers. The median is kind of that tried and true at $150,000 over $500,000. Think about that as you kind of go. Multiple offers, 37.2% of homes are averaging over 3% of asking price. Average days on market, 22. Median days on market, 9%, 9 days on market. So when you're really doing that, homes under contract in 7 days less, 46%. So that's almost half the homes are snatched up right away, meaning there's probably multiple offers, meaning that's happening. So we're cooling a little bit. That number is down, right? 46%, first time we're below 50% in a while of homes selling in under 7 days. But when we really step back and look, the market is still holding. The market's still holding true. There is less transactions, so there's less people out doing it, but the averages are holding true. The prices are holding true. It's not like any of these people are getting a major discount. So that's not what I'm talking about here. Don't come to the market expecting a major discount. Come to the market expecting a fair fight, not, a major bidding war typically, as long as the home's priced accurately off the get-go. But then we're there. So that's the net is, okay, what does all this mean, right? The market's still, appreciating. It's still pretty tight. Average days on market are down, whatever. Obviously active listings are going up. Pending transactions are going down. So those are some good, touchy-feely kind of things, but it's not going to be easy. It's still, you have to come and compete. You're not going to get the best deal ever. You're just not going to have to raise, and you're not going to have to compete at such high levels like we experienced over the last few years. And you will have to pay a little bit more. The cost of living is going to go up. So what's going to happen when we get to this point? Here's the deal. You can either wait and take advantage of those low interest rates. Maybe you time it exactly right and you get in just before the crazy bidding wars start happening. Absolutely positive. That would be great. Timing the market is always really hard. Or you could get in now. And like I said, you get in now, you get locked in, maybe you get a little bit of a buy down, maybe, there's no competition on the house that you want. You can get a little concession to help you with a buy down of some sort. You get that rate, into the sixes or something that's palatable for you and your budget. And then you watch that rate. And if it ever gets below, half point or 3/4 of a point, then you can refinance. But once the rates really drop and dip off that much, you're going to see the rush of people to the market. You will be a homeowner at that point. When that happens, the homeowners will get richer and the renters will get poorer, because once that happens and the prices drive up, what's coming next. Rents are going up right behind it. So now maybe just the opportunity to get the right start, because if you buy on the tail end of the bidding wars and the prices appreciate and you get a good rate, but what happens there, right? What happens if the prices fall 5% or correct 5% after that crazy spending spree that some think is coming when those rates dip? Then you're upside down, and then you don't have as many options, and you're kind of truly locked into that home. Or you have to do something worse than that and lose money, and sell it. But that's kind of what I'm concerned about. Not to say that you should be scared of the price dipping 5% or whatever, but it will correct. And if you bought at the top of the market, April of 2022, exactly what I'm talking about. 2021, whatever, exactly. If you paid $100,000 over it, you're just now catching up 2 or 3 years later to, have that value kind of come to fruition. You may have been upside down for a little bit once the market shifted, but it wasn't the end of the day. You just paid that mortgage rate and you're good to go. So you don't want to be in that place with a low down payment, where your down payment basically has disappeared, your loan to value has disappeared, and you can't refinance at that point. You don't have options at that point because you bought at the height of the price appreciation growth that is said to come. And then it comes down just a little bit and you feel that. So that's exactly what I'm talking about. That's the net. I hope that this resonates with you. Here's the deal. If something I said struck a chord and you're interested and you're like, all right, Jeremy, let's talk about this at least, and I'm ready to understand it, I promise you that I will give you my opinion. I'll help you with the market, help you understand the market. And if it's not the right time for you to buy and it's better for you to wait, buy or sell, we can talk about that. However, I will tell you, it's always a good time to buy if you're renting. If we can get you out of that lease and start building your personal wealth, that's my goal, to help you build wealth through real estate. So I hope that helps. August 2023, wild ride. We'll see what September, we'll see what these winter months hold. We'll see if the seasonality kind of comes into play. Usually the seasonality has a factor. Sometimes we zoom right through it, but let's stay in tune with these stats, because it's ever changing and the headlines are just there to curb your enthusiasm, for lack of a better term. But just understand that the headlines are there to scare you. If it bleeds, it leads. And that's not exactly what we want to be doing and believing when we're talking about our own wealth. So Jeremy Kane, eXp Realty, like, comment, subscribe. We'll talk to you soon. Bye-bye.